All right, guys. Thank you again for the opportunity to be here today. So we are going to be discussing a presentation that I used up in Chicago for business owners. And it is to piggyback off of the summit meeting that we did in Miami. We put it to work. Aziz, I see you on here, and Aziz was my business partner in crime for that presentation. And we had about 8 to 10, business owners there, potential new agents as well. So, Aziz, did you want to say a little something?
Yeah, I'm sorry, I'm driving to my doctor's office, but uh, I think this is
Did we lose you? You still there? Oh, I was excited to hear what he had to say. Oh,
I received the calls. Can you hear me?
now I can. We lost you for a
Oh,
sec.
okay, I'm sorry. All right, so I said right after the presentation and all, and we break the fasting there and all, but right after that, I start getting the text message and all, and we had to meet a couple of them very next day. We were at the coffee shop at 9:30 at the nighttime because he's like, no, I wanted to come in. I wanted to see Phil. But it's a really good response, and I can't wait to Phil come back on in August, and we could do this in a bigger scale.
Yeah, I'll probably find another time. And thank you, Aziz. I really appreciate the opportunity to come up there. I'll probably be up in the Chicago area at least two more times this year, just from the standpoint of production and things like that. But again, the goal here
And
is
good food
tax
too.
deduction strategies.
Phil, good
Uh,
food too. Good food too.
two, yeah, at least
Yeah,
two, at
good
least
food. No,
two.
I'm saying good food also, not only
Oh,
for.
good food. Oh yeah, yes, yes. That deep dish pizza, I tell you, it gets me every time. Legit, I gained 8 pounds over a week. I lost them, but I gained them at that point. So it's good food. Um, but yeah, so what we have here is a presentation that we did for tax deduction strategies for business owners. And the idea really is that how can you leverage what you have at your fingertips? Everything on this has no advisory, no financial advisors. So you as independent agents can do this with a life license and a health license, and that's it. Okay. So what we're going to talk about is the differences in the agenda here is what can we do to help business owners reduce their current tax position because every business owner today wants to talk about tax deductions. This is the perfect time to have a tax reduction or tax deduction type of conversation. Mr. and Mrs. Client, did you get enough tax deductions this past year? If I could show you a way to increase your retirement strategy as well as get you more tax deductions, would you be interested? Who's going to say no? So today, what we look at is the agenda here of different strategies that we can offer you business owners an opportunity to plan appropriately, retire the way you deserve, increase your employee retention, and ultimately protect your business. So, when we first talk about retirement plans, what we want to look at here first and foremost is the Secure Act 2.0 highlights. Why is this so important? When we look at the idea of tax credits and incentives for starting a retirement plan, this is so important for business owners because they're always going to talk about, oh, there's fees for plans. Well, if I could tell you for the next 3 years, you could save a $5,000 credit per year for 3 years to cover the setup and administration of the plan. That's one perk of the Secure Act 2.0. The next one, you talk about employer contributions. Can everyone see my screen, or is Nana the only one?
Yes, we can.
We can see it.
All right.
We can
So
see it. I can see it.
yeah, no, it's your fault, not mine. Um, so when you talk about employer contributions, so you're giving a match to your employees, things along that line, you're going to get up to $1,000 per employee in contributions, again, for the first 5 years. Then we have auto enrollment. So if you're going to put your employees into a plan like a 401k plan, you have the ability to do that, and you'll get a credit once again on your taxes the first 3 years up to 500 for each employee, or 1,500 total, I should say. And then, most importantly, for those who are a little older, you have a catch-up contribution up to 60 to 63. It's like a super fund of 11,250. Standard deductions for above 50 will get another 8,000. And so right now for a 401k, you can put in this year 24,500. So again, you have additional catch-ups that you can do depending on age. So one thing that, if you'll notice here, that's highlighted in red is the word credit. Why is credit so important? Well, when we look at credit versus a deduction, once again, the top line versus the bottom line, if we had a credit, with the credit, I get $5,000 for an employer annual fee. My tax bracket's 37%. I am saving $5,000. It's a straight line deduction on my taxes. Whereas if it was an actual deduction, I'm going to not get the full amount in regards to saving on my taxes. I would have a deduction only of $1,850 as opposed to the $5,000. So I'm losing money due to a deduction versus a credit. So why do retirement plans matter? Once again, they're the dominant thing that most people talk about as business owners on getting to your retirement or the needs for retirement, but you can get massive tax deductions. So contributions are 100% tax deductible, reducing your immediate income, taxable income. Employee retention. How are you going to keep your employees? It's so important to be able to offer benefits and tax deferred growth. So your full benefit goes towards growth versus Uncle Sam taking money out of it in the first place. Yes, there's arguments of do you want to get taxed on the seed versus the harvest, but when you look at this and when you look at why these type of plans matter, in order for you to get to the 37% tax bracket in retirement, you have to be making over $400,000 in your retirement years. So unless you're the upper echelon, you're probably not going to be hitting that tax bracket when you get to retirement. Yes, the tax rates can go up. However, you're not necessarily going to be at those top marginal tax brackets. And you still have to go through the 10, 12, 22, 24% before you get up to the top marginal tax brackets in retirement. So we look at the biggest one of all, the traditional 401k plans. It is the most popular retirement plan, really for any business. I don't want to say small business. It's the one that's most known. The key features are you can put 24,500 into these type of plans this year. Additional opportunities if you're over 50. And either through employer matching or a profit sharing plan, you can increase by up to 25% of the total compensation. So when you think about it, like for myself, Phil Resch, I am 50-50 owner of Valor with my wife. Okay. So we can each put 24/5 into a 401k plan, and then we can put 25% compensation into it as well on top of that, which in this scenario or this case, you'll see the limit is about 72,000. Okay. So if we look here at the tax savings example, a business income, someone makes 500K, they put 72,000 away into a 401k, they save 26,640 on their taxes. Now, I know some people here are saying, well, that kind of stinks because I'm not getting a full deduction of 72,000 if I'm putting 72,000 away. So it's all in the shift in mindset and how you look at this, okay? So if, for example's sake, I was looking at it from the standpoint of if I spend 72,000 to save 26,000 in deductions, what am I truly doing? If you look at this slide deck, you'll see a kind of like a gas gauge. So on this end, you have 26,000 in what you're giving to the government, okay? But on the other side, you have 72,000 that is going towards your retirement. So what you're actually doing is you're putting in place a $98,000 swing for the employer to take money that was going to Uncle Sam and throw it all the way over into their own retirement for growth that they can pull out later at a lower tax bracket. So the 72,000 becomes active and you're not putting money in Uncle Sam's pockets. Now, once again, yes, there are fees to this, okay? So with our one of our providers, they have an annual admin fee of 750, but once the plan gets to 150,000, that 750 goes away. They have participant fees, so $25 per person, but once again, 150,000, that goes away. Advisor comp, 60 basis points. It's usually between 50 basis points and 1%. Okay. So that is the comp for the year. It is what you would call assets under management. It grows over time because these assets will continue to grow. But the idea, and you'll see here in a minute why this is so advantageous for you in this process. There's always going to be a third party administrator. That's what TPA stands for. And investment expenses, 22 basis points. So that's what's inside these asset fee options. You'll see here you have 1.05, 112, and 1.2. These are going to be the fee structures for the fund families that are going to be in the accounts. Okay. On the flip side, what you're getting from a benefit is the unbundled proposal. So what this means is it's unbundled. You can put different fund families into the portfolio. The clients might be favoring one set of fund families versus another, but you can mix and match. That's what unbundled means. We partner with Lincoln Financial, who's been around for over 100 years, and they provide a website. They provide financial wellness, including budget creation. You can increase the usability by linking in outside accounts. And they even have a subscription elimination service that's available. And on top of that, like I said, with the unbundled part, you have so many different fund families. So if you have someone who is like, well, I'm just going to go to Fidelity and open up a solo 401k, that's fine. But you have Fidelity here. Unbundled means you can get some in Vanguard, you can get some in Fidelity, you can get it in American Funds or Franklin Templeton. All of these are major money market, money management companies that all provide different values. And here's an example of what a lineup would look like. As you can see here, you have different strategies like Vanguard, you have American funds, you have these target dates. So, what are target dates? I'm 44, so my target date would be 65, which is 21 years from now. So, I would look for a target date around, let's say, 2055. Am I doing the math right? 2045, somewhere in that range. But what happens is it's more aggressive now, and as I get older, it flips over to a more conservative to protect my assets. It does it for the client. And so the secret to this sauce is we use a non-registered variable annuity. You do not need to be licensed in order to utilize this. The carrier will provide the support and the help to help the client on the back end. So if the client needs to change your allocations, they would call the customer service number. They would not call you. So once again, you're the conduit to bring in the opportunity. And then after that, they take over, you're still the figurehead, but they're doing all the heavy lifting. Next, we talk about SEP plans. Why do people use SEP plans? Most of the time, if you talk to accountants, CPAs, the first thing they'll tell their customer is, hey, you need to get a SEP plan because you need to get deductions. SEP plans are great because they're easy to maintain. You don't have ERISA guidelines to go with that, no annual filings, and you can put up to 25% of your compensation up to $72,000. It is employer funded. So, when you look at this standpoint, it works very well if it's maybe one or two people, so employer only funded. It's flexible, so you can choose how much you want to put in every single year. So those are reasons why you would do it. Here are the reasons why you wouldn't do a SEP plan. Okay, so this is education for tax preparers, for CPAs, because a lot of times, again, they're giving people advice on how to get deductions. They're not telling them exactly how to, because that could be a break in what you would consider their role or their job. So why not to choose a SEP? The uniform contribution rules. So everybody in your organization has the same percentage. So if I have 10 people, they all get the same percentage. There's no deferral. So you're vested day one. So let's say, for example's sake, I employ someone and I give them part of the SEP contribution and they quit the next day. That is theirs to keep. You cannot separate that and give them a vesting schedule like you can with a 401k and with a profit sharing plan. There are no Roth options. You can do a Roth with the 401k, and there's no catch up after age 50. It's the same thing. 25% max is what you can put in. So it is good for solopreneurs, people again who want very clean, very easy, simple. They don't want to think about it. Yes, you agents can also sell SEP plans. We have several carriers that can provide this too. It's more on the annuity side, so they do have that, but yes, you can offer these as well. Now, when you think about a base or a foundation, what I would say is the SEP is a one-man show. It's a one-man dog and pony show. If you flip the script and you talk about the 401k, that's the entrance into additional conversations. So, for example's sake, adding a profit sharing plan can allow you the opportunity to increase that amount. So, again, we talked about employer contributions, or we could talk about profit sharing plans, which allow you to maximize your contributions. Now, the big thing here is allocation options. We have pro rata, age weighted, and new comparability. What does that mean? So, pro rata means everybody gets the same percentage. So, if I'm doing a profit share, I say we did great this year. I'm going to give everybody 10% of this $100,000. 10 employees, 10 grand apiece. Simple math. Okay, age weighted means that we can do based on age. I'm 44, everyone else is 20, so I get a higher piece of the pie because I'm older in a age weighted type of allocation option. Now, where new comparability comes in is that gives you the option to, depending on your title, you can segment or give more to certain classes inside of your organization versus others. So that allows you the opportunity to be a little biased when it comes to this profit sharing plan and essentially give more to people you want to versus others based on their class. For example's sake, dentists and doctors versus nurses and hygienists. If there is more on the table and the doctors and dentists want more, they should be allowed to get more. It can be paired with a 401k, as I mentioned before, and customized vesting. So when you think about a profit sharing plan, your employee has to be employed for over 5 years. So a total of 6 years and up in order to qualify for vesting. So once again, we talk about employee retention, you have it right there. If they leave, then that money goes back into the overall kiddie pool. Now, take a look here. We have contribution. Okay, that's a voluntary contribution. We're going to flip the script now to define benefit plans. Okay, these are for your higher net worth individuals, those who have higher incomes, uh, specifically for people 50 plus, and have the consistency of high income, whether they disclose it or not. I'll put it that way. Okay. So the big perk on this is that they want to catch up. They want to get more deductions. As you can see, you can deduct up to 400,000 per year. The idea is that you have the ability to put more away and you can segment more to the owners versus the rank and file. So if you think about it, you have, like a stupid diagram, you have the 401k, then you have the profit sharing, then you have the defined benefit. I'll put DB because we have two different kinds. So when you talk about deductions, this is one way that you can do it. Now, on the flip side, we have 412(e)(3) plans. These are also defined benefit plans, but what they have is a focus of life insurance and annuities. Now, why does that matter? You can get higher deductions by incorporating life insurance and annuities inside of your retirement plans. So, what does this give you? Again, it's a defined benefit. You have guaranteed retirement income. You have tax deductible contributions. You do get life insurance built into it, and there is no investment risk. It has to continue to go up, and you use assets that do that, and it's predictable. Okay. So, some of the reasons why people like this, once again, they have consistently high income. They can carve out, so say it's a family business. So you have a carve out for, say, husband and wife. Maybe the kids are involved too. And then you have some rank and file. You can super fund the family before you think about everybody else. You have to supply to everybody else, but it doesn't have to be a full-blown funding strategy. Now, the cool thing is that if you incorporate life insurance protection in this, it can be taken out of the plan at retirement. And so, how does it get taken out of the plan at retirement? So, let's say I have $1 million policy and I have 400,000 in cash. Well, if I'm at we'll just say 40% tax bracket because I want to try and make this as easy as possible. So that would be 40, 60, 40, 80, 160. So if I put $160,000, which is the total tax on a $400,000 investment at 40%, back into the plan, my life insurance policy comes out of the plan. It's called a swap. And then your cash value is tax free, your death benefit is tax free. So there's benefits even on the back end to help the business owner get tax deductions today on life insurance plans and then pay less in taxes or overall later on to make it tax free. So the question is when you think about it, the 412(e)(3) plans are a great strategy to help you get some life insurance-based sales plus annuities. And the problem is, though, is that a lot of people will compare them to the open market. Okay. The S&P did like 20% last year or whatever. But if we look at these 412(e)(3) plans, the idea is not so much about your rate of return, it's about a tax deduction conversation. Okay. So, a simple question that I like to ask, if the maximum benefit you can receive from a defined benefit plan is $290,000 guaranteed per year for the rest of your life, starting at 65, what makes more sense? A double digit return, say 10%, or a 5% annual return? So, just the poll, if you want to put it in the chat, which one would you pick? Would you pick a 10% return or a 5% return? No one's so bold as to put their answer in the chat, or did I already put people asleep? All right.
4%.
Hey, don't be a cheater, pumpkin eater.
Had to
All
slip
right.
in.
Of course. So if the end goal is the same, let's say we have a 40-year-old, okay, and the end goal is $3 million. $3 million will give this 40-year-old guaranteed income of $290,000 for the rest of their life. We'll look at a 10% versus a 5%. So age 40, 70,000 per year will get this person to $3 million by the time they get to 65. But in two different plans, you have one that's 10% and you have one that's 5%. You will hit $3 million by the age of 56 with the 70,000 per year with a 10% plan. You will hit the 3 million with a 70K per year with a 5% plan. Either way, the number is the same at 65. Because it is a defined benefit plan, the benefit is defined. You can't go any higher than that. So when you look at this, you have now limited your tax deductions and you lose out on roughly 7 years of getting more tax deductions for yourself and for your business. So obviously it's a trick question. A lot of people put 10%. And I'll say some people have heard this before, figure out why 5% makes sense. So again, anytime you have a conversation like this conversation is not to be, confused with rate of return, because how many of us have had conversations about insurance products versus non-insurance products and rate of return versus, what you get in the insurance product, and everyone gets PO'd because they're not going to get 20, 30% returns in an IUL. This is not about that. We care about slow and steady wins the race. And like I said, if the finish line number is the same for both, why would you want to lose tax deductions when you don't need to? So here's a good example of how this can work. We have a dentist office, so two dentists, 52 and 39, making 500K and 200K, and they use that comparability, the new comparability. They have an office manager, a hygienist, and 3 additional staff. Now, what they want to do is maximize for the owners and minimize for all the other employees. So we looked at several different plans. So if you look at the SEP, like we talked about before, you have to give equal contributions to everyone. The percentage is the same, no vesting, everyone can walk away with it, but there's a tax savings here of 56,000. If we flip the script and just do a profit share, we can still use the same deductions for the business owners, but now we have the employees, we reduce theirs, and we reduce the overall tax deductions. You start elevating the game by adding the 401k in with the profit share. As you can see, your tax deductions back up, and you have more there and a little less or a little more for the employees. So as you can see, the big ones over here on this side, you're adding in defined benefit plans, you're adding in profit sharing plans or cash balance plans, profit sharing and 401k. So like I said, you're stacking to give people more deductions. Now, obviously we like this one. Why? Because it has the 412, right? With the life insurance and the annuities, you'll see $600,000 in deductions. You have, actually, excuse me, 750,000 in deductions 127 goes to the employees though. So this group, they went with this one where they only gave 9,700 to the employees, but it allowed them 360,000 for the business owners. So you see how that works? You have different ways where you can traditionally, or you can shift and provide a better value proposition for the business owners. But also, let's think from the mindset of what we're doing. That is 2 owners. Now you have an office manager, hygienist, and 3 staff. That's 5 prospects to talk to as well. Free leads, however you want to say it. So this might look familiar to someone, but I blocked out the names for protection purposes, of course. So in this scenario, we have 8 people, and the annual administration is about 5150. Okay. It takes 2750 to build out the plan. But again, remember, we have those credits that we're getting from the from Uncle Sam. And so what we have here is a basic setup plan. Now what you'll see here is 2 owners. So we'll say father and son. They can put voluntarily into their 401k plans. Okay. The other one here for the 52,000 is the wife. She doesn't really participate in the plan. She doesn't participate in the business, but you can add her on as a business owner and she can then stuff more money away. So long story short, what you'll see here is you have a total on this side of the fence. You're giving the employees 11,193, but that unlocks the defined benefit plan where the employees are only getting 97.67 and the owners are getting $247,000 more of deductions. So when you see the total amount of deductions, the majority of it is going to the owners and the owners' families as opposed to the employees. So a lot higher than just 24,500, a lot higher than 72,000. You're giving someone a load of deductions. And over here, this is life insurance premiums. So 98,800, and the carrier we use pays very well for whole life. And you have an annuity right here that's going to pay every single year. And so every single year you get, say, 4 or 5% off of that too. All of a sudden you start to see things stack up. And not only are you providing a huge value proposition for the business owner, you are now getting a renewal for your own practice as well. I call it mailbox money. So that's the retirement side, okay? On the other side, for those of you who have health licenses, there are ICHRA plans. If you do not have health licenses, we have a team that can help partner with you and work through that process. I would highly recommend it if this becomes something of importance to you, but we have an avenue for this as well. So what are ICHRAs? ICHRA versus a traditional group plan. So the traditional group plans typically have costs that can increase. If you have 1 or 2 people who tend to overuse these services versus the rest, you will see an increase for the entire organization. ICHRAs allow you a fixed monthly allowance as a business owner. Coverage options on the traditional, it's one size fits all. So if you have employees here in Tennessee, some in Georgia, some in Florida, Florida's over here too, then all of a sudden they might not have the same type of doctors that you would have in Tennessee where the foundation or the organization is. So now all of a sudden, these people have one size fits all. Here we can choose your marketplace and you can pick who you want. Typically, there's a lot of paperwork that goes along with this, a census, the whole 9 yards. This is a simple reimbursement process, and I'll talk a little bit more about that in a sec. Tax deductible premiums plus tax free to the employees. Ooh. And then you can once again customize these by employee class. So you can, as a business owner, be biased. So we look here Again, 100% tax deductible business expense. It's not treated as a wage. It reduces business income and improves cash flow. Why does that happen? Because you are avoiding things like FICA, federal unemployment, and state payroll. It's predictable. You can determine as the employer what you want to contribute by class, by age. You can have fixed, predictable costs year after year after year. I have no idea, Penny, and that's why I'm glad you're here today. So, customization, it's no more one size fits all. So, I could do a United Healthcare. My other business associate could do Aetna and continue down the path. It increases retention. It helps people recruit more employees because now they have a benefit package plan. Matter of fact, from what I was told by our ICRA guru, that Chick-fil-A actually now uses ICRA plans. So what happens is you have a cost savings for the employee. You have customization so you can pick your plans, and portability. So if I leave my employer, I don't have to go with Cobra. I can just pick the same plan. And so, if, for example's sake, so there's a few people on this call, let's say we had a company of 20 people, and I had myself as the owner, and I wanted to give myself $1,000 a month for employee contributions towards my health plan. Now, I could do that, again, avoiding FICA, Social Security, federal unemployment. But let's say, because Rick just put his camera on, I don't like Rick as much. So I'm only going to give him $500 a month towards his health plan. I have the ability to dictate that. And that's where, if you'll see here from the savings plan, this is 10 W-2 employees. Before, with the group plan, they were putting in $9,800 a month or $117,000 a year with renewal increases at 14%. Flip to the ICHRA plan, the physicians, they're being biased, got $900 a month, and the staff got $550 a month, saving them roughly $39,500. Now, what can you guys do with $39,500? 401k, life insurance, annuity, whatever. You're the professional. What you're doing is you're uncovering assets, giving them more deductions, and then in return, you're now opening up more assets to be deployed for other things. So the benefit of this is it creates predictability, more deductions, more opportunities for retention for those businesses who might not even have a health plan. This is a great tool to help with that. And it's a seamless process. All right. Business owner protection. We're going to do rapid fire with some of this because I know we're getting closer to time and people might have some questions. So, business protection strategies. If you are dealing with business owners, some of the biggest things you have to remember is you have to protect against unwanted ownership. So if I am a business owner, I'm going to pick on Rick again. Rick is my business partner. We're 50-50. I die. Rick is not 100% now. Rick is still 50 and my wife is 50. She gets the other set of the assets because it's a unlimited marital gift. But now Rick is doing 100% of the work. So the idea is we want to talk about buy-sell agreements. How do you protect against unwanted ownership? So Rick buys a policy on me. I'm the insured. He's the beneficiary and the owner, and vice versa. So we pay off each other's spouse at time of death, and we get the full kit and caboodle. Those are buy-sell agreements. Okay. Top level. Okay. So do not get this confused with key person. Key person is top level and the mid management or level below. So if I have a top producer that passes away, now my business isn't going to incur a loss. So I buy insurance on them to make sure that if they pass, I can still keep business moving in the right direction. That's all that is. So I buy a policy, picking on Rick again. Rick is my top dog. I buy a policy on him. I'm the beneficiary. He's not. His wife is not. So that might piss him off because he's like, what's in it for me? So I say, you know what? You're a great employee. I'm going to give you an executive bonus plan. So if you want to talk about a wage deduction for the business owner, I can give Rick a $20,000 bonus. I'm not, don't think I am, but I can give Rick a $20,000 bonus to which he would put that into a life insurance policy designed for accumulation, low death benefit. So now I'm giving him a retirement plan I don't have to give to everybody else. Okay. So now I'm going to get a wage deduction for this. Now, all of these LLCs, S Corps, sole proprietor, not a C Corp. I mean, you can do it with a C Corp, but when people are asking about tax deductions on buy, sells, and key person, no tax deductions for sole, LLC, S Corps, but C Corps you can. Okay. This executive bonus will give you a wage deduction for one of your employees, unless your employee is yourself or your spouse, because they're in the same tax code, your same taxes that are filed. There's no benefit because it's a straight line, to you on your personal. So you're going to pay taxes on the wage that you just gave yourself to give yourself a bonus. So the executive bonus with a tax deduction works if it's not someone you're also claiming as a dependent or filing jointly. Okay. Additional options and resources. So we do offer alternative investments. So the ideas of these investments include 24-month, 36-month, 48 or 60-month deals. So this is straight up. So when you talk to business owners, they're always looking for places to put money. This isn't a tax deduction opportunity, but it's invested through land. These deals change all the time. So this is what we have as of, March 5th, but they could change. So just giving you an idea here, you do not need a license to sell these products. We talk about commercial property and casualty. So we've got our business partner, Mr. Rick Sladen here. He is our Grand Poobah. He is the master of this commercial, not domestic, commercial
Yeah.
PNC.
Yeah,
So
unless
you
you're
want to say a quick word?
I think Aziz is one of the guys that's really took off with this. Like, he has a lot of business owners, so he's getting up and going and looking for opportunities, and he's finding a lot. And that's how you find hopefully your pensions, your 401ks, all this stuff that Phil's talking about. It's just an added service that Phil is bringing to the table for all our agents. So it's not too hard to process. It's a little aggravating sometimes with some higher risk stuff, but it's just extra business for you. I mean, as an agent, you don't have to be licensed. Phil's handled all that with setting everything up through Smart Choice. So, you don't have to be licensed to be involved with it. If you are licensed, then we add you as a user and do other things. But if you're not, we can still do the business and you'll get compensated for it.
Yep. And so for my friends who have hotels, gas stations, convenience stores, workers' comp, we found out that we can do vape shops. So that's a big one too, because a lot of places won't cover that. So we have a strategic partnership and opportunity to help you grow an additional line. And again, and I saw it firsthand with Aziz. He walked into business owners and he's like, "Give me your policy of your current PNC for your business," and he's going to sit there, he's going to evaluate it, not right there, but he's going to evaluate it. And then from that standpoint, you come back, say, "I can save you money here." What'd you just do? Build a trusted bond with them or her. And now you have the ability to go in with other things. So he can only ask for that because he knows them. But if you know business owners, you have a tree of opportunity here, and this is just another resource for that. So here's some of the opportunities that you can do. So, you talk about tech, you've got, industrial electronics, integration, data hosting, data processing, so IT. You've got retail. You've got professional liability like accounting. Um, no, Jose, we would make sure you're taken care of. So I'm not greedy. It's an opportunity all across the board. If you're licensed, it makes it a lot easier for. So help me, help you, help us.
That's one good thing
Uh,
about these policies is there are renewals every year on them. So they pay like life, not necessarily, but these they do pay on renewals. So
yeah, it's not like life insurance,
yeah.
but it's something to keep the lights on. So yes, you'd be taken care of. No worries. Popular carriers nationwide, CNA, Chubb, the Hartford, these are just a few. We have specialty ones too where needed. But long story short, you definitely have a opportunity here. In regards to implementation, we have Trusty Friend. So that is a service that we have where you can do wills, trusts, irrevocable trusts. You can do buy-sell agreements, key person, executive bonus. So they are your key source where you can get paid, and what I call it is the vulture effect. So vultures go like this, they block out all other predators or competitors as they're eating. So now you have a trusted friend when it comes to the opportunity to protect your business so you don't lose it to a lawyer who has a friend who works in New York Life. Happens. Last but not least, we have multi-life guaranteed issue. Yeah, Rick, go ahead.
I was just gonna say they're really good to work with too. Not a cheap plug, but they're awesome. Me and Phil's dealt with them with a high net worth case. They're really, really good about dealing with your client. Excellent.
Extremely.
Highly
Yeah,
recommend
extremely.
them. Yeah.
So, and then this last one, and then we'll open up for any questions, is multi-life guaranteed issue. How do we do this? 10 plus people in an organization making north of 75K, and you can get guaranteed issue IULs up to 500K or more, depending on the size of the group and the amount of money each individual makes. So, if you think of it from the employee benefit package side, maybe you have a C-suite of people that you want to give that executive bonus to, and now all of a sudden you have, say, 10 people in that category, you want to give them 10K a piece. It's 500K and up, but you can also give, 10K a person, and they could do 150,000 face, 250,000 face, whatever. The idea is that this is basically guaranteed issue. I don't want to say it's fully guaranteed issue. They ask three whole questions. One is, have you been in the hospital in the last 6 months? Do you smoke? And one other one, but they're yes or no questions, and there's no back and forth with underwriting. So if you have a team, realtors, some people ask about associations. You can't go to Remax and say, I want all of Remax to do this. However, if there's a office of Remax employees in the Dallas-Fort Worth area, that's all part of the same organization, that could go for something like this. You need at least 80% participation, but it's exclusive, so only put on the people who want to do it. But nonetheless, it's an opportunity where you can get, say you have a unhealthy business owner and they have, say, 10 people who want to do this too. This can work for Valor as well. So if people were interested in getting another 500K, maybe more for a LERP type design, it's an accumulation based IUL. It's through Symetra, but it has an opportunity for you to make 10 quick sales. So say it's 5,000 a piece in target premium. That's $50,000 right there, plus renewals, plus again, you're deepening the relationship with the business owner. So again, things like that are available through this process. Thanks, Matt. I wish I saw you. I wish we could have met up in Chicago, but next time. Next time. Um, so really that's it. What I would say is that from this standpoint, schedule some time. Okay, now not next week because I will be out of country next week, heading down to the Bahamas for spring break. So um, I'll be out of pocket from September Saturday to no Sunday the 8th to Saturday the 14th. I can do phone calls, text message, stuff like that. But if you want to do a Zoom, what I would say is hit up my calendar. So I'll put it in the chat. So it's just simply appointments.valorfs.com. And if you have clients who can fit one of these solutions or strategies, let me know. We can dive into it. What I would say is one case, one case on the pension side, you're looking at somewhere between 50 to 100 to $200,000. So if you do one a quarter, right? It takes a while to do them. But if you do one a quarter, can you imagine what that would do to your bottom line? All by having the conversation simply around saying, what type of tax deductions are you looking for? Right? All business owners are looking for tax deductions. So if we can provide you a value and on the same token, everybody wins, there shouldn't be a problem there. So I will open it up for any quick questions. Anybody have any questions that you want me to answer nowish? Nothing.
Hey, Phil, I have a question. So
Yes.
when you're working like this just came up the other day. So, I have EAs and CPAs that I'm working with in conjunction with and all that stuff. So they're not giving clients, they're telling clients like, hey, you owe this much, even if they happen to be like paying for planning, which half of I mean, 90% of people are not.
Mhm.
They still are only getting like you need some tax deductions or this is all and it's behind and it's be so how can we like I think that that's just a really untapped referral partner. What's the best, like you just said those words, what's the best words that we can use to help them understand like this is where we come in?
Yeah, what I would say is, especially for CPAs, the simple response is, hey, I know you deal with a lot of business owners. There's a reason why you're a CPA. Um, in this strategy, what are you typically doing for them when they need tax deductions, right? And they'll say, well, I tell them to go get a SEP, or I tell them to go talk to a financial advisor, or they might have someone. So for them, what is it always about? It's about retention of those people, right? So for their services, they want retention. So if I can increase your customer retention and increase the value of what you bring to the table, could we talk about tax deductions and ways that we can personally help you guys help your clients? Um, Ultimately, to be quite
Yeah.
frank, most CPAs will probably get a life license or someone in their organization. Um, and so you can say, hey, I'll do all the work, put you in on it for a split, and then they get excited.
Okay, yeah, I'm doing it.
Yeah, and I agree with you, Bailey. A lot of CPAs don't do tax strategy. They take numbers and
No.
throw them in the system. That is true. Literally had that with my CPA. He's like, you
Yeah,
need
I've
to do
had to
this.
amend a lot of CPA taxes because they're just not maximizing the deductions or even guiding these people on like what
Yeah.
they're entitled to. It kind of pisses me off, to be
Yeah, they don't
honest.
care. They don't care.
Yeah. So
So I would
their job is to
suggest
just
working
say,
with like a tax, maybe like a tax preparer, like someone that doesn't have all those letters behind their name because I know like I'm not an EA or a CPA, but I do a lot of tax strategy and tax planning. And I use my insurance license obviously for this, but there are people who have even reached out to me asking if I'm teaching these things. So maybe work more with not necessarily like a chop shop, I guess you could call it, where they're just throwing it in and
Right.
sending them on their way, but people who maybe are more intentional about helping
yeah.
these clients with taxes.
So
Okay.
the big recommendation would be, and in this I've seen pretty successful in a few places is to do a insurance weekend. So say the first Saturday of the month. Now, if for example's sake, you got four CPAs or four trusted partners, that's, you know,
Yeah.
four Saturdays, right? And in doing so, you say, hey, here's a strategy. Line up four people or four appointments or three appointments. Boom, boom, boom. And then exercise with that and then move on to the next week with the next one and the next one. So what happens is that you can again increase their revenue share, increase their value of what they do, and it's only once a month. They don't know you're meeting with other CPAs and doing the same thing. So that increases your brand
Mm.
and your upper echelon employees or customers.
Yeah.
Again, you get a business, and now the business has 10 employees, and they want to do planning for everybody because they keep seeing you. So it just increases the overall story that you can provide. And again, we have an avenue for all of it. Life, health is all you need, the life and health license, and we can get you with everything else.
You just need one, but the CPA is going to be the gatekeeper at the end of the day of the money. So you're going to have to go through them. So be prepared. The business owner can be all fired up, but at the end of the day, the CPA is going to be the gatekeeper of the money. So you have to really get with them and
I'm
just
not scared. I'm
once
used
you
to
get
arguing with them.
one, then it falls into place. But they are the gatekeeper.
Okay.
Trust
I
me.
was just saying, Penny
What
has
I
the
heard you
sweetest
say
smile, but she's
is,
ruthless.
yeah, I'm not scared. I go toe to toe with CPAs all day long. Um, I need to go get my health license. That's what I heard you say.
If you are going to do the ICHRA plans, you would need your
Okay.
health license. Yeah.
Yeah, well, the ICHRA plans are like a no-brainer for my clientele.
Yep.
Okay.
Yep. So my girl Gloria, who's not on today, she's the ICHRA queen. So she can help from that process, getting people set up for ICHRAs. And so as you see how the tree is aligning with Valor, so I'm still very in tune on the life side, retirement planning side. I added my advisory. So if you have clients who are looking for managed assets, I can't give any compensation referral off of that, but we also have the additional sources of revenue for like commission-based products that I will never veer away from because they're so valuable. But Rick, as I mentioned, PNC, commercial PNC, he's the smart cookie. That's why I said I want to partner with you. I want you to handle that. Gloria with the health side, got the ICHRA stuff on lock. So we have resources and people that are building out to create a bigger structure for Valor. So this is just the beginning, but there's a lot of great stuff happening.
Cool.
Thanks,
Love
Rick.
it.
Good seeing you.
Yeah, this is great. Thank you.
So, all right. Well, I actually have to run too. It's my son's lacrosse game. I missed his first two. And so this is his third one. So I don't want to miss that. But this recording will be up on the YouTube probably tomorrow. But I want to say appreciate you guys for sticking around. Holler with any questions. And thank you guys very much. Appreciate it.